Yes, sir, I'm here.
So the platform is yours, Mr. Rajiv.
Thank you so much for your kind words. Now, as discussed, I'll have to send you a pizza for all the kind words, some false, some true. Thank you so much. If you could make me the host, that would be great. Yep. All right. Do you guys know what is the lifespan of a currency note like rupees 10, rupees 5, rupees 20 in your wallet? It's just 5 years, maximum 5 years. You heard it right. Maybe by the age of 50, you would have seen these 10 rupees notes, 20 rupees notes recycled at least 10 times. All right, let me take a quick quiz. Let's see how many knows the answer. Tell me, how many languages are there in each currency note? Be it a 5 rupee note or a 10 rupee note. Type in the chat section, how many languages are there in the currency note? Anyone? All right, pretty close, pretty close. Yes, so the answer is 15. See, we all want to be rich. We all want to have a lot of money in our bank account, in our wallet, but we never paid attention apart from the Gandhiji, whether he's a big Gandhiji or a small Gandhiji, depending on the size of the note. But there are 15 languages on each currency note. I'm going to talk about building wealth. And someone told me, health is wealth. So I started thinking that, okay, I'm going to talk about building wealth. Health is wealth. So essentially, we are going to talk about building health. That's right. I'm going to talk to you about the nutritious diet, your diet plan, your 2 protein shakes a day, and what all things you need to do to stay fit, stay healthy, and maybe gain weight or lose weight. Some would be thinking, wow, what a bummer, what a disappointment. We were hoping to get rich, and I already take 2 Bonvitas a day. I don't need any nutritious diet plan because my 2 Bonvitas a day are enough. I wanted to be rich. Well, the person has a point. We can maybe shelve this topic for some other day. We'll talk about becoming rich, how to become rich, and I can assure each and every one of you that by the end of this topic, you guys are going to be rich. That you heard me right. You guys would be rich just by attending this session. You don't have to wait for 10 years or 20 years. You would be rich. All right, so let me tell you what exactly do we mean by being rich. Rich in general means having a lot of money, right? But what? Dhirubhai Ambani had a lot of money. Mukesh Ambani also has a lot of money. Of course, they are rich. But I'm sure someone in your colony, someone in your town, in your city, or someone a bit far, you would always having a big house, having a big car, would be considered as rich, even though that person could have just 50 lakh rupees, or maybe a 1 crore rupees, or maybe having a lot of black money. You don't know. But those people are also rich. So how would you define being rich? Rich essentially means that your earnings are far more than your expenses. And here, the earnings is not a simple earning. The earnings when you're not working, the earnings when you are out on a vacation far in Maldives and for a month, and still your earnings are continuously coming, not in the form of salary, because you are just enjoying and you have no plans to work. You are working, you are not working, you are enjoying somewhere. You probably have definitely plans to visit Europe or maybe go to Goa, but you are not working. And then also, if your earnings far exceed the expenses, that's when you would be rich. Think about it. If you are sitting at home watching some shows, watching some TV, taking classes here, and having a great life, going out for dinner without worrying about anything to do for next day, next week, next month, next year, maybe next 10 years. That's how. And your earnings, your money is still flowing into your account. That's when a person becomes rich. So I will now want you guys to focus on what essentially I'm talking about. I'm saying that earnings minus expenses are essentially your savings, right? Earnings minus expenses are your savings, and earnings, when they are greater than expenses, is when you would be rich. Now, pay attention. These earnings are not simple earnings, these are idle earnings. And when you say idle earnings, you are essentially have to focus on this particular thing. Now, we all want to become rich. We all are have to think about this equation. Earnings minus expenses is savings. And when you have to focus on this equation, you have to figure out like how I would find out these three things so as to start living like a rich person. There are three variables here: earnings, expenses, and savings. What we can do is we will figure out what are the expenses. We will figure out few other pieces so that we can identify how to live like a rich person. So I hope everyone has taken a good look at this equation. We are going to talk about expenses and earnings and savings, and we are going to figure out all these things so that we can start living like a rich person. Now, if every one of you or whosoever stays till the end, I'm going to share a secret sauce. Yes, a secret sauce. My secret sauce. I'm going to share with you, which will help you staying rich and maybe even more stinking rich, if you may call that. Stay till the end. You would have a secret sauce that's going to be a game changer in this whole thing. So now let's talk about expenses. We are going to talk about a story and a disclaimer initially. It has nothing to do with anyone dead or alive. All right. So it's a story about a handsome hunk, Ritik. Now, Ritik is about 25 years old. He has some plans to retire. He wants to live like a rich person. We all are alike somewhere, right? You want to live like a rich person. I want to live like a rich person. Ritik also wants to live like a rich person. No problem with that. So Ritik has a monthly expense of 20,000 rupees. We all know our monthly expense. It's very easy. Each and every one of you who is earning, of course, would know how much are you spending out of those earnings. So we all know our monthly expenses. And now is the time to start behaving like a rich, being like a rich person. So pay close attention to this chart. Here, what we are actually going to do is that Ritik is 30 years. He thinks like he would have to think how many years he's going to work. Afterwards, he can go on a vacation. Ritik says, I'm 30, I just want to work till 55. And then I don't want to work, but I still want to continue living a rich life. So based on that, here is this table, which is definitely going to help a lot. We talk about inflation. Just for everyone's understanding, inflation is price increase, like the tomatoes which you buy in the market today. The tomatoes today could be 30 rupees a kg. But do you know, 10 years ago, those same tomatoes were about 8 rupees a kg. And maybe 20 years ago, those same tomatoes were just 3 rupees a kg. So this price increase in tomatoes and in each and everything you see around you is called inflation. So we have to think about the inflation as well, because when the Ritik retires in 2047, like 25 years from now, Ritik's whatever expenses are would not be the same what they are today. They will be higher. And this table is going to help us determine how much Ritik's monthly expenses would be when he decides to retire. So we see from this table, it's very intuitive. 6% is the inflation, which is a long-term average inflation. And then 25 years is additional time when Ritik is planning to work. So taking up this factor, we figure out that his monthly expenses would rise to 85,000 a month, the same expenses. And when you people would work on this side, on the expenses side, you also need to factor in your future expenses. Maybe later on you would have a family expenses over there. You would have some plans to do something, maybe buy a house. Those would also be expenses. But ultimately, living a rich lifestyle essentially needs to have a very average kind of expenses. It's very easy. You would think, oh, two months ago I went on a trip. I spent a lot during that time, and right now I'm not spending as much. So just think from the last 6 months perspective, average it out, and if you want to be a conservative, maybe add some additional amount in your expenses just to take care of your future additional expenses which you are thinking about. That's how you would get your current monthly expenses. And in case of Ritik, you saw that it becomes 85,000 a month by the time he decides to retire. So on an annual basis, Ritik is going to spend 10 lakhs. Simple calculation, 85 per month into 12 months is 10 lakh rupees. So that's what Ritik is going to spend by the time he retires. I hope this is making sense to you guys. Feel free to ask a question in between if you want, or chat a question if you want. It's up to, feel free about it. There is no such protocol where you have to wait till the end. So we talked about expenses, right? Again, looking back at the equation, expenses is something we figured out. That was anyways the easy thing, low-hanging fruit to quickly calculate. Now, the second thing is, which is a bit trickier thing, I admit, but what's the fun if the things are not trickier, right? So the second thing is, now Ritik also needs to think about his life, like how much does he plan to live after retirement? You all guys would be thinking, hey, I'm immortal. Maybe 200 years? Can I think about 200 years? Whatever I think about right now, would it actually happen? Yeah, we all want to live longer. But still, let's be more practical. You would say, okay, I'm being practical now. 100 years. I am definitely going to see my great grandchild as well. I'm not going away anywhere. Yeah. Why not? That's right. And people are there on the planet living for 100 years or more. Let's be a little more reasonable now. You would say, okay, Not yours, not mine, 75. And that's what Ritik also thought. What a coincidence. Ritik also thought that at least he would live until 75 years of age. So even though he retires at 55, he plans to have a great life for 20 more years. And so for that, until his age of 75, he needs to have a lot of money, which would take care of all his expenses, and still he would get some additional earnings. But you know what? Inflation is going to bite during that time as well, because the price is continue to increase month after month, year after year. So when the Ritik is planning to retire, he would have to factor in the inflation. So now I would talk about one another important thing, which is how to think about the retirement corpus. Like, this is the amount of money you would need to have by the time you retire. That corpus, that retirement amount, would help in sustaining your rich lifestyle even post that. So if we look at this table again, then again, assuming that 6% will be the inflation rate, Ritik plans to have a life expectancy until 75 years. So the retirement corpus with 10 lakhs per annum expenses, it turns out to be 1 crore and 68 lakhs. 1 crore and 68 lakhs. All right. So I have started receiving questions. That's great. And let me pick up the first question while we speak. Okay. So there is a very valid question, and that's about the rupee depreciation. So for the starters, for the people who are still um, trying to understand all these topics, please don't pay attention to this question. This is for more complex learners who are already ahead in the curve. So the rupee is depreciating, correct? The inflation is very high, agreed. But we are talking about 40 years, 25 years. Ritik is just 30 years old and he's talking about his life until 75 years. Over a period of 40, 45 years, all these things would average out. Have you guys heard the law of averages, where everything would average out over a period of time? Don't worry about those small things. Even though the rupee is depreciating, it would continue to depreciate. There's no harm in that. But the point is that because of rupee depreciation, because of inflation increase, if you look at 30-year, 40-year averages, you would land at about 5 to 6% inflation. If India continues to grow the way it is, then that's how you would see it. If there are some big changes, a war breaks out across the globe, then things would be different. But why to worry about such extreme situations? So I hope I answered that question. So now coming back to our story around Ritik. 1 crore 68 lakhs is what Ritik would need by the time he retires at the age of 55. Everyone can think about retiring early, later, it's fine. Accordingly, you will have to make sure that you have to get that much of corpus to live a rich and great lifestyle. So now don't get bogged down by this 1 crore and 68 lakhs. I'll tell you, because we are going to now talk about the savings. That's right. We are going to talk about what we are essentially going to do to have this corpus, even though Ritik's monthly expenses are just 20,000, and we are telling him, hey, you have to build 1 crore 68 lakhs by the time you retire. And Ritik would be like, oh my God, I need to earn a lot to make that money. No, that's not true. And we are going to talk about how much he needs to save and make wise decisions about that money to be rich. So moving on to the next piece, and this is a very important piece. So now I have everyone's attention, so please pay attention. Don't get bogged down by that big number. I'm going to talk about this important thing wherein we are going to now see how much Ritik needs to save every month to be a rich person for his entire life. So again, I have a table. You guys would be able to see this table even after the presentation because it's a recorded session. You guys can go and look at this one. So now we have to think about an investment growth rate. So this is a tricky part. Investment growth rate would always be generally more than inflation to start with. And other than that, you would easily get 10% over a long period of time. Stock markets give about 15%, and very safe like savings account at few banks give even 7% just on the savings balance. So you can think like you would always have about 10% over a long term as an investment growth rate. And we will also talk a little more about these details in some time. So again, for every 10 lakh rupees as the retirement corpus, and based on the years before the retirement during which Ritik plans to work hard and live like a rich life, we come out at 753 rupees for 10 lakhs. Overall, doing these calculations, we are talking about 168 lakhs. It's based on 10 lakhs. So the amount comes out to be just 12,000 rupees, 12,600. That's all. That's all Ritik needs to save and invest every month to have a rich life. And this rich life can start from today, can start from now, because you all would be knowing how much your expenses are, how much you are looking to work for, and then accordingly you can adjust your savings to make sure that those savings would be enough to have a great life for the rest of your life. It's a very important concept. Let's think about that equation again. Earnings minus expenses is equal to savings. But now this equation doesn't look right? Because Ritik is now going to invest those 12,000 rupees every month to have a rich life. So this equation changes a bit, not much, but it changes a bit. Equation now becomes earnings minus expenses minus investments is equal to savings. And now, even after making those investments, if say Ritik is earning 40,000, his monthly expenses are 20,000, he is investing 12,000, and then still he's left with 8,000 rupees. That's amazing. Now Ritik can go to a 5-star hotel. Ritik can go to a Goa vacation, and he doesn't have to worry about it because he's already earning more than his expenses. And on the other side, if Ritik suppose is earning just 30,000, then valid question. Ritik is thinking, hey, what to do now? It means that Ritik needs to if Ritik wants to live a rich life, then Ritik needs to cut down on his expenses a bit so that his expenses and his investments equal to 30,000. It's fine if he's not able to save any additional money, but having a proper plan for the rest of your life to have a rich lifestyle is extremely important. And I have put in a tidbit here, and I'll keep sharing such kind of funny facts. in investing, and we are talking about investments because we are talking about long term, always remember that Rome was not built in a day. If you would have seen Rome, or if you would have seen those images, it's a magnificent city. It's a city people dream about to go in, and you would have seen a glimpse of these cities in many movies or even on Google. So the point here is that investment needs patience, and over a period of time, it gives a lot of results. Whereas in trading means you think about, okay, I'm putting in 12,000 today, but I don't want to put, or after 2 months, I am going out on a vacation, or I am doing something for which I am buying the car and I need to take out all my savings. Then it's a big mistake. It won't help you to have a rich life. So that's why I always remember that this Hiroshima and Nagasaki were destroyed in a one day. So it's important to think about long term. So we have now started talking about investments, right? And you guys would be thinking, yeah, investments we heard about sounds very reasonable. What exactly it is? What are investments? Fairly straightforward thing. It's an act of committing capital or giving capital in return for some additional income on that capital. Capital means money. You are putting some money at some place with the expectation that you would get additional income from that money. And it's a beautiful concept. It's a game changer in each and every way of investing. Because we are talking about investments, investing, and these investments work in a crazy manner. While you are sleeping every night, these investments would continue to work for you. You don't have to think about your investments whether working about with for you or not. They would continue to work for you. Even if you are working, you take a vacation, you go out for a week, then also these investments are very diligent. They would continue to work for you. And how do they work? It's called compounding, compound interest. Now, compound interest, everyone would have learned about it during the school, right? So how many people have interest in compound interest? Type Y in the chat section to tell me if you guys know the equation of compounding interest which we learned during our school years. Let's see. Yes. People do know. I'm sure everyone is amazing here. Great. People are paying attention. I'm sure you guys would be learning something new, and hope by the end of this session, and especially after I share my secret sauce, which is really secret sauce. Secret sauce, just to clarify and more generalize a bit, it's a secret thing which I have, which I'm going to share with you guys, which will help you guys make very solid investment decisions. So when we talk about this compounding, right? So we are talking about compounding. What we are essentially saying is that when whatever income you earn on your money, that income, that whatever additional income is, that would also start working for you because that's yours, and all the money works in the same manner when properly invested. It would also start working for you time after time, day after day. So that's a very simple concept about investing. Maybe taking a quick walkthrough, or maybe taking a quick example of our favorite poster example here, which is Ritik. So taking an example of Ritik. Now, and this is just to show the value of compounding. Ritik started investing 15,000 from the age of 20. You know, he's a smart boy. he started investing early. Whereas Kangna started investing rupees 15,000 again, same as Ritik, but at the age of 35. They both get 5% interest. And since we talked about compounding, people know about compounding. So they look at the amount they have at the age of 65. As you would imagine, Ritik's that 15,000 becomes 1,35,000, whereas Kangna's amount becomes 65,000. Not bad, but do you know what's the difference? The difference is 70,000 rupees. And why so? Because Ritik invested those 15,000 rupees 15 years earlier. So whatever money he earned between age 20 to 35, that helped him to learn, to gain more, and that money essentially kept working for him. So now another quick question, like let's take a quick quiz and see whether who gets it right. Now Ritik is getting the 70,000, like this is the 70,000 difference, right? Who would get the 70,000 additional money? Type in the chat section, who is going to get this 70,000? Who is going to enjoy with the 70,000? Let's see how many of you know that. All right, so we have started receiving some answers. Yes, yes, pretty close, pretty close. So I think I'll have to share the answer here. The answer is Sabha. She is going to enjoy with this 70,000 rupees. She doesn't need to invest. She has the 70,000 rupees which she can enjoy with. And like I mentioned before, this story has no relation with anyone dead or alive. Always remember that. All right. So let's move on to our next topic. We talked about investing. We talked about compounding interest, which is definitely a game changer, right? And now we are going to talk about where to invest in. We understand compounding, but what are the different avenues? Avenues are like, maybe I'll start talking about these avenues one after the one and maybe explain it to you right now. So let's start with the same FDs or bonds which we're talking about, which works great in this environment. So fixed deposit, I am sure each and every one of you would have seen a fixed deposit in a bank through your parent, through directly yourself, through your relatives. It's a very common thread, I think, which ties the whole of India. People are very savvy about saving their money in a bank account. And that bank account is good, but people also go ahead and do a fixed deposit, FD. And that gives you a rate of return. What essentially is a FD? It's like you are giving a loan to a bank, and bank is saying, okay, I will pay you 7% interest, and it will be compounded. So it's a great way to save money and earn money in a very risk-free manner. Because if you go to SBI or ICICI Bank, these banks are not going to fail. And even if you go to a smaller bank, RBI insures your deposit. So again, you are not going to lose money. So always think about getting the maximum rate of return on your fixed deposit or on the savings account balance, because it's included in the investments you make every month. That's the beauty. And that's a great thing about it. An alternative way to think about FDs are bonds. Bonds are something like the company would come and they would say, give me money as a loan and I would return you your money along with interest. And generally, these companies hire a lot more interest. If you guys remember Muruppan Finance, which is a gold finance bank, I remember they issued some bonds which was offering 12 to 14% of interest every year, which is great, even more than our investment return expectation, which is at 10%, right? Why so? Because there is a risk of losing capital in such situations. That's why company understands that and gives a reward, gives like a gift to the investor that, hey, you are just getting 7% in SBI, come to us. I know there is a higher risk with me, so I'll give you 5% additional. So that's how the bonds or FDs would work. People can think about investing in this kind of investments, which are called fixed deposits or fixed income investments. Now, we'll talk about another thing, which is stocks. Stocks are another great way to invest. Stocks, what does essentially stocks do is, like, there is a stock market. What company comes to you, company is not asking you for a loan. Company is saying, hey, I have this company, I'm working on this, and can you also be a shareholder? Can you also be a partner of me in building this company? So here there's a difference. Earlier they were asking for a loan. Here they are giving you a partnership. They're saying, you can give me money, I will use this money, and I'll give you some partnership, and I'll use this money to grow my company even more. And how companies do that? By the means of IPO. You would have all seen LIC IPO, which was out in the market just few months ago, or maybe actually few weeks ago. There was so much of advertisements around it, so much on the news channel it was discussed. It was such a great investment, government is diversifying, and so many things around it. But as I said, there is some risk. Over a short period of time, LIC started going down right from the day of listing. But I am positive that this stock is going to go up when you think about a long-term perspective. 20 years, 10 years, I can assure you, you would make more than 10% on this stock also, because it's a good stock. It's a good company. That's why. So that's how the company does. And after, like, company is done with the money, then the people, the shareholder, can go on the stock exchange, where they can trade shares. Like, suppose Ritik purchases Reliance stock from the company maybe 20 years ago, even though he's 30, but he was very savvy. Even at the age of 10, he started investing. So if Ritik invested in Reliance and has a partnership in Reliance, he can go on the stock exchange and can sell it. He doesn't need to go back to the company. So he can sell it to someone else who wants to be a partner in the company. So that's how stock works. What essentially you get from the stock, you would get a dividend. Like, company made $10 or 10 rupees every year, but company doesn't need that much of money. So they will give that 10 rupees to all the partners in the company, right? That this is my earning, I don't need it. You can have it as a part of dividend. So that's a income stream for you guys. I hope it's not going too heavy. I'll take a quick pause. I'll see if someone has any questions, but I hope we are still on the basics. We are not talking anything complex. Very basic things: stock market, trading in stocks, doing an FD, very basic stuff. So another one is mutual funds. Now, when we talk about mutual funds, what essentially happens is that in the stock market, you always have to be at least in the know what's going on with the company, whether the company is doing good or bad, so many different things, right? Because ultimately your stock value would increase only if the company performs well. So what you can do alternatively is, if you think like, oh, it's too burdensome on me, I'm already so much busy with my life, I don't have time to look at the stock market, which is a fair thing. You can put that money in a mutual fund. So mutual fund is, there is a person called a fund manager. He would take care of your money. His day in, day night duty would be to make sure that your money grows within the stock market. Very straightforward thing. There is someone who is ready to take your money and make sure that it grows. But to do that, of course, that person is also wants to become rich, right? Everyone wants to become rich. So he would also have some savings, some investments. So he would need earnings for that. And how would he get the earnings? He would get the earnings by managing money of everyone like you, the investors in that fund. So in essence, the person give would charge a fee for that, and that's the drawback of it. The next one, so I have again got a tidbit quickly. I'll share a tidbit. So here the stock market CEO is calling and saying, hey, we are beating expectations, as in whatever you expected from us to do, we are beating expectations. And in the end, if you see in the background, they're beating a person called as expectations rather than actually exceeding your expectations. Well, that's a fun part. So, all right. So quickly, the next one is ETF, very similar concept. It's just that ETF is traded on the stock exchange. So you don't have to go to a fund house like a mutual fund company. You can directly do the trading like a stock market. Other alternative and great sources of investment are gold. Yes, we all have gold. We love gold, right? And many of you would be having it on you right now in form of a ring, ear, like a tops, ear ornament, or a chain in the neck, or maybe somewhere in the locker. So gold is again a great investment. It also increases with time. So Ritik has an option to also invest in the gold. Another one is real estate, where you would buy a property and then you would get a rental income from it every month. And the house property would also increase. So these are all great ways and great places to invest in. Now I'm going to share another quick tidbit. So here you are, like here is the Ritik Roshan. He thought about some trading strategy. He thought, okay, I'm going to do this and this. And then he saw a shooting star, Toota Tara. So that's what he looked at, a shooting star. He quickly wished with his fingers crossed that, hey, I wish my trading strategy would work. And the moment that shooting star heard that, it reversed its direction. It said, no, 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 I'm not breaking because I cannot fulfill your promise. You are asking me a tough question. So it's important to understand how much risk you want to take. If like you are Ritik, have a long period of time to invest in, you can be a little aggressive. You can invest a lot in the stock market rather than in the bonds. So you can be aggressive because stock market would always give a good return over a long period of time. Whereas over a short period of time, these bonds, these FDs would give you a better return. So always remember that. And that's where people talk about diversification. Now you have, Ritik has 12,000 to invest every month. Where to put that money? All into FDs, all into stock markets, or in gold, or in a real estate? Such a difficult thing. So what the experts suggest is invest in everything, small by small amount. So that's where the diversification comes. That's what we call as diversification. So I will quickly walk you guys through this, and we are about to end, and I'm about to share the secret sauce which everyone was waiting for. And this is going to be a life-changing knowledge, I can assure you. So quickly covering the kind of investment strategies. Like I said, if you have long-term, invest more in equities. If you have a very short period of time where you would think, oh, I just want to invest, maybe I'm already 45, I want to retire in next 5 to 10 years, go more heavy on the fixed income, which is bonds or FDs, and be lesser on equities, because you don't know how the equities would perform in next 5 to 7 years, which is still a relatively small period of time for a stock market. And the best strategy would be, I think, moderately aggressive strategy, wherein you are also in the stock market for about 50% and other 50% you are somewhere else. So now is the time for secret sauce, everyone. Yay! I am so glad that all of you made it till the end, and this is going to be extremely helpful. Lot of people always think about, how would I know when to invest in a stock market? I understand this diversification. I understand that, okay, I can put some money everywhere, but when to invest more in the stock market? There are some good times and some not so good, not too good times in stock market. And you can find out by looking at the label. And how would you do that? There are some experts who are giving this for free, which people like you and I can rely on. And that's called Motilal Oswal Valuation Index, right? So what you would essentially look at is just type movie Motilal Oswal Valuation Index and type this in Google. You will come across this link, which will take you to a page which will show this valuation index. This is for the last 6 months. People who are already in the stock market would know that the stock market is going down. It's crashing a bit. So earlier it used to be very high, and that's how you would see this line here, that it was at a high level, and this red shows the sell zone. This is the time people should have sold their investments because it's very high. And now, because of this recent drop in the market, it's now in the white area. It's not in green yet, but it's in the white area wherein people can continue to invest based on their risk return profile, based on what they plan to, but they don't need to sell. They also don't need to purchase anything additional. And when this this chart goes into green, that's the time when you should think about investing your additional savings as well into stock market, because it's a great time. People, the stock market is really low. It was actually showing green in March 2020, when due to COVID, the stock markets just crashed along with so many apprehensions around it. So this is a great resource for anyone to think about when to put more money, when to just put the money you want, and when to put lesser money. So I would quickly conclude that it's very important to stay invested. You can start living a rich life right from this moment onwards, because you know what your expenses would be into the future, and how much you need to invest every month to have a comfortable, rich life, wherein your earnings are far more than your expenses, and you can be out on a vacation in Rome. All right. Thank you so much, everyone, for staying with me till the end. Back to you, Arindam, sir.
Wow, thank you so much, Mr. Rajiv, for such a splendid performance. Today, I have literally learned a lot. In fact, while you were speaking, I was keeping a note of it, though for the second time I was listening to it. But after paying close attention to the information and basics, now I'm pretty sure that in future, if I consider going for investing, these lessons will help me a lot. And the best part is such a simple, lucid, and lucent manner you have described the entire scenario. And I believe that Mr. Rajiv has literally worked and put in his hard work to ensure that the explanation goes simple and you can understand each and everything. Now, the platform is open for Q&A. If you have any question, or if you would like to share your feedback, or anything that you would like to share your experience, your session experience, you can simply unmute your audio. You can put up your concern or query or feedback if possible. And Mr. Rajiv would be glad to be taking that.
So before we go there, I would just quickly answer one question, which probably I missed while I was talking about it. It was from Rajiv, like in what kind of stocks we should invest in. It's a very valid question. And what personally I do, I'll share my recipe with you. What essentially I do is I don't go into stock picking. It's a very, I would say, a tough job to pick the right stock which would grow over a period of time. Because based on my personal experience, I have invested in some stocks like Kingfisher Airlines, which are nowhere now. Like I lost all my money because the company went bankrupt. So what I would essentially strongly suggest is either go for a top performing mutual fund, which you can find out from Money Control. Go for a top performing mutual fund and continuously, just maybe every 6 months or once in a year, see that whether that mutual fund is among the top performers or not. If not, then take out the money from the mutual fund and put again in a top performing mutual fund. Or secondly, which is again a great strategy, is invest in a Sensex or invest in Nifty 50. So there are some ETFs which you will find in the market where you would just invest the money, and that money would be invested in those the index directly. So if the market is going up, your money is also going up. You don't have to think whether the underlying company is performing well or not. You are simply going to track the market. If the market is right now down, it's definitely a good time to keep investing what you have planned to invest. And as if the market drops more, feel free to put in more money. And as the market goes up, your Nifty 50 kind of the ETFs would also grow with the market. And one another good part about investing in such a thing is that the expenses are very low because the manager is not using his intellect to choose investments for you. He's simply investing in all the underlying investments behind a index. So it's a very simple job which anyone can do. So the expense ratio is also low. All right. Now I open the floor to everyone, as Arindam sir mentioned.
Yes, Miss Anita.
Yeah, thank you so much, Arindam. It was a great pleasure moment for me because first time it happens in our workshop that someone actually said about the investment. It's a great moment. But Punit, right? Punit,
Yes.
actually, I have one question. Although
Sure.
that I have invested a lot into the mutual fund, but I really wanted to know one thing from you, that blue chips companies are only like play safely, or shall I also put certain amount into the SMEs?
Right. A great question. So thank you for this question, ma'am. The
Yeah.
thing is, the blue chip companies are the companies which pays good dividend.
Mm-hmm.
Now, if you are expecting
Mm-hmm.
income from
Mm-hmm.
your investments rather than just the appreciation, then these
Mm-hmm.
blue chip companies are great. They might not appreciate as much, but they would give you a regular source of income in the form of dividends. What I would suggest is always it's better to be safer than sorry. So invest 80% of your budget for the mutual funds into the such blue chip companies, and 20% you can play around a bit. You can look at the top performing mutual funds which are specialized in small caps or mid caps like the SMEs, and
Mm-hmm.
invest in those top performing mutual funds. They are there in the market. If it's coming from a very well known brand like ICICI, SBI, LIC also have their own mutual fund, you can
Mm-hmm.
safely assume that those people would take a good care of your money. And
Mm-hmm.
like I mentioned, every 6 months just check on Money Control whether that mutual fund house is among the top 3 or top 4 performers or not. If it's not, then take out money from them at that point of time and put it to another mutual fund house which is performing well.
All right. Punit, I have another question to do that. Although I know about it that 100 rupees it starts, you can invest that much. You can start from there. I just
Right.
wanted to know one thing, that what is the right like investment amount, or like what kind of percentage person can get easily, like what is the right investment amount, like a 6,000, 7,000, 8,000,
Right.
10,000? So what is the
Right.
right amount? Yeah.
Right. So I would say it all depends on the expenses which you are having currently, and if you want to have the same good lifestyle for the rest of your life. If
Mm-hmm.
if that everything is true, then like if I take the example of Ritik, who has monthly expenses of 20,000, but he wants to have the same kind of life. So his monthly savings comes out to 12,500 rupees roughly. So out of this 12,500, since Ritik has 25 years to retire, he should put at least 75% of that, like be aggressive, put 75% of that money, which would roughly be around 8,000 every month in the stock market, and rest 5,000 in a FD. With it could be a recurring deposit or it could be a FD, so that every month his this complete portfolio is going well. But when the stock market is too high, like I showed that Motilal Oswal valuation index, when the stock market is too high, then what I would recommend is Ritik should stop investing in the stock market and put all that 12,500 rupees in an FD, because the market is too high, it would go down. So Ritik can wait, and can accordingly redefine his strategy for a short period of time. And when, like right now, I think right now the levels are that we can stick to our allocation strategy. If we are planning 75% or 50% into the equity market, we should continue to do that. It's not very high, it's not very low, it's somewhere in between. But if the stock market goes low, again, like in the green section, if Motilal Oswal says now it's a good time to buy, then Ritik should stop putting in his monthly savings from into an FD or a recurring deposit. Rather, all money should go into the stock market. So that's how, if we can tailor our strategy based on how the market is performing, it's going to have a better return over a period of time.
All right. Thank you so much, Puneet. It's a lovely pleasure, conversation, and you shared each and every point which actually I'm looking for. Thank you so much for this.
Pleasure is all mine. Thank you, ma'am.
Thank you, Ms. Anita, for asking such an impeccable question. And still the platform is open.
Hello.
Yes, Raju, please go ahead.
Yes. Thank you, Arnab. And thank you for a wonderful session, Puneet. And you added valuable wisdom to all of us. Very grateful. And I have one question, Puneet.
Sure.
Right now, I'm not investing on any stocks and mutual funds, everything. So I thought of investing into the paper gold, which you were talking about, right? Paper gold. So, and what question is like, if I invest in gold, will I be able to convert that into physical gold whenever I require?
So, the paper gold, you mean the sovereign gold fund, which is okay. It's
which you can find in
best.
Yep.
Right, it's the best strategy to invest in gold. If whatever you want to invest in gold, because it's giving you 2.5% every year, like a interest, and along with the appreciation in the gold. But if we think about diversification, and this diversification is okay, so your question is more about whether you can convert that gold into a physical gold, correct?
Yeah. Gold, and always when to invest on gold, for example, beginning of the month or end of the month, any particular time, or I need to follow regularly when gold rate will reduce, then I need to invest. That's my question.
What I would personally suggest is, like again, going back to Ritik's example, 12,000, Ritik should not invest more than 10 to 20% of his monthly investments into gold. So, and like gold is such a volatile product that we can just safely invest every month and into the gold, or like whatever frequency you want. Even I've seen people, they do a one lump sum amount in one sovereign gold wealth fund once in a year. That's it. Because gold should not be the key focus. The key focus should be the adjustment between the stock market and the FDs. Gold could help because, you know, I can go in more details, but it really helps in diversifying. That's why just a very small portion. So Ritik should never look to invest more than 2,000 rupees every month in gold. That's how I would put it. And there is no like strategy being gold being overbought or oversold. It's just a good asset to have in. That's all.
Thank you, Raju. Thank you for such wonderful question. And I believe the same question is going to help the remaining participants. So now we are about to conclude the session. Now, before doing that, for sure, Mr. Rajiv, you have literally worked in a lot of, you have put in a lot of effort to make this workshop successful. And fortunately, we have recorded it. So in case if anyone has any question, I will take that question, and for sure, I will forward that question to you so that after the workshop, whenever you have time, you can answer those questions. And at the end, I would like to thank all the participants for staying till the end. You joined sharp on time and still you are with us. It really means a lot. And I would like to congratulate Mr. Rajiv on his first workshop on communication skill, and that too in stock market, which is of course one of your favorite topics. And we are really expecting a lot more workshops like this in upcoming future, Mr. Rajiv. So thank you so much.
Thank you so much, sir. Thank you, everyone.
Thank you, everyone. So God bless you. Take care and be ready for the next bashing workshop in the upcoming weekend. God bless you all.